How did Warren Buffett, Jack Bogle, John Templeton, or Peter Lynch grow massive fortunes, starting with virtually nothing and without investing heavily in real estate to a large degree? Well, they focused on the fundamentals. And what do I mean by that? Well, by the time you're done watching this video, you'll know exactly what I mean. Plus, you'll know how to do the very same. So, lovingly, tenderly, gently, smash that like button for the YouTube algorithm, and let's get started. You're watching Finance Squared, and I'm your host, Derek West. On Finance Squared, we love talking about all things personal finance, including stocks, crypto, real estate, and the strategies and techniques that will help you to grow your wealth, including fundamental investing analysis. Now, those kinds of topics are how you get down. Do yourself a favor and subscribe to this channel and turn on post notifications, the little bell, so you don't miss a video when they drop. In the world of investing, there are a couple of large strategies that different investors employ based on their temperament, risk tolerance, investment horizon, and patience, frankly, to help them grow their wealth. You're probably very familiar with day traders and algo traders. Those are the traders that you see mostly represented in the movies and on TV and YouTube videos. Some YouTube videos anyway. Those guys trade on signals that they get from markets, buying on every type of investment instrument out there, whether vanilla or exotic. That's a whole other video topic. Vanilla investing instruments versus exotic investing instruments. When I talk about vanilla, I'm basically saying stocks, bonds, mutual funds, index funds, ETFs, REITs, and real estate, among other things. Exotic investment instruments would be things like Forex. Some people would say crypto, commodities, options, puts, among other asset classes. And there's probably thousands of them out there. Now, before you guys jump down in the comments and start arguing with me that crypto, Forex, and commodities should be considered vanilla investments, I had to draw a line somewhere. So A, like and subscribe, and B, just calm down. We're about to get into the good stuff. But day traders have their own set of strategies and analyses that they try and do in an attempt to, quote unquote, beat the market. And they can be doing that for a couple of reasons. For one, beating the market means that they make more money than simply putting their money into an index fund that tracks the market, making their time and their talent extremely valuable. Number two, they could be working for a mutual fund that is not indexed. Yes, they still exist. Or hedge funds who have similar goals but much different clientele. And thus it is their job to try and beat the indexes which they are competing with. And if they can do it or come close to doing that, they can be compensated very handsomely indeed. You know the stories and the rumors of the rich Wall Street traders. Well, those are those guys. To a large extent. Number three, they could be day trading off the technical analysis of the stock market and on other signals, but market-based and external to the market, trying to scalp off multiple positive trades and profit based off of the volume of profitable trades that they make. Number four, in the event of a bear market, they could be trying to keep their and their clients' losses to a minimum to try and avoid losing money altogether, or in the best case scenario, profit off of a bear market. And yes, there are ways to profit off of a bear market or a downward market. Again, a topic for another video. Like and subscribe. Whatever the reason is, there are hundreds of thousands of traders who try and do just that. Trade investment instruments mostly in the short term in the hopes that they can beat the market. My friends, while that is a popular formula, it's probably not the most tried and true investment formula. Nope. The tried and true formula that many famous investors tend to use themselves and that many people argue is the best formula is buy and hold investing. Buy and hold investing is where investors buy or invest in securities or other assets for a longer period of time with no intention to sell in the short term, in some cases with no intention to ever sell. In other words, it refers to investing for a long period of time by retaining the investment and usually ignoring the ups and downs in individual market indicators and signals over a short period of time. If you're an investor who adheres to this strategy of investment, you're investing on companies or cryptos or real estate plays fundamental analysis. This analysis includes factoring in the performance of the asset, its long-term growth strategy, and consequently, its growth potential. If it is a company, the type of product it offers, its competition, its market segment, its regulatory burden. You can consider this strategy the safe and steady investment strategy, as opposed to the live fast, die hard strategy of day trading. More formally, fundamental analysis is a method of measuring a security's or asset's intrinsic value and examining related economic and financial factors. If you're studying the fundamentals of an asset, you're studying anything that can affect the asset's value, whether it's macroeconomic things like GDP per capita in a country, market saturation of the product the company is selling, average sales price of the asset at hand, state of the economy overall, industry conditions adjacent to the asset, things of that nature. But it can and does include microeconomic factors, including the effectiveness of the company's management, price to earning ratios, total debt owed by the company, gross revenue, gross profit, unit profit on all items sold, etc., ad nauseum. The goal of all this analysis is to arrive at a conclusion as to the likelihood of your investment returning a profit in the long term. And that term can be anywhere from a year to a decade to 5 or 6 decades. If you consider the fundamentals, from the broader economy to the company details, you're doing fundamental analysis. You're doing this because at the end of this process, ideally, you'll have determined the asset's fair market value, and you should technically be able to find assets that are priced higher or lower than their real value, with the real value of an asset being the current price that it trades at in whatever market you're analyzing, stock, crypto, real estate, and the thousands of micro markets within each of those markets. And fundamentally, doing that will allow you to profit on those investments. So let's get down to how to analyze the fundamentals. To learn how to perform fundamental analysis, we need to get a good idea of what the standard metrics are that most people would consider fundamental values for that company or asset. You see, like a lot of things, what one person considers a fundamental value, another person may not. Most everyone agrees that revenue and profit are important metrics of a company's fundamentals. But what about market share? Quality of management? How do you determine which values to consider when analyzing a company's fundamentals? Well, first, you need to break down your analysis into quantitative and qualitative buckets. Quantitative fundamental metrics are metrics that are related to information that can be shown in numbers and amounts, whereas qualitative metrics relate to the nature or standard of something rather than to its quantity. So basically, it's the idea between measuring something versus the intangibles of something. When you measure something, that is what it is, for lack of a better phrase. For example, if you're doing fundamental analysis for a company's stock, that company's revenue is that company's revenue. You'll have to forgive me for using a sentence to define another sentence, or a phrase to define another phrase, but it's like the popular phrase, it is what it is, meaning it's not going to change, whether you like it or not. And assuming the example company's books are not cooked, which is another topic for another video, then that is a number you can rely on, help you make an informed decision on the value of a company. The quality of a company's key executives, its brand name recognition and reputation, quality and number of patents, and proprietary technology are more qualitative metrics of a company's fundamentals. Those are things that are not as easy to define and measure, although many people have tried. You need both types of metrics to help you make a great decision on an investment. For example, imagine you were considering investing into a company. You sat down and did your research, and you found out that a company had solid revenue, but also found out that it didn't own any of the patents and the products that it sold. That is a company that's going to be in a world of hurt in the legal system in the near future, and probably one that you should stay away from. With that example in mind, what qualitative fundamentals should you consider? When considering the qualitative fundamentals of a company, what are some of the most important ones you want to consider? Well, there are typically four that a lot of analysts review. Starting with the company's business model. This is an analysis of what the company does. What is its vertical, i.e., where does it sit in the marketplace? Is it a consulting company? Is it a manufacturing company? Is it in retail? How does it generate revenue? Does it give its main product away essentially and upsell services around that product? Understanding the business model of a company or even a market segment that a company exists in is not simple at all. There are many ways to look at it and many different things to understand about it. So much so that it probably would make another great video. I keep plugging my channel here, folks, but I'm telling you, like and subscribe. Inevitably, studying a company's business model will lead you into studying that company's competitive advantage, with the understanding that a company's long-term success is driven largely by its ability to maintain a competitive advantage and keep it. A company that can create or find and keep a competitive advantage can make their executives and shareholders a lot of money over a long period of time. Think of some of the big name brands that you know of: Coca-Cola or Pepsi, Microsoft and Apple, Amazon and Shopify. Each of those companies, or maybe one or two companies, has created their own niche which they are dominant in. Each of them will probably enjoy lucrative and profitable years until such a time as they are disrupted by up-and-comers. And if their management is aware of that risk, then they will be taking steps to help insulate themselves from that eventuality. Speaking of which, management is typically one of the next qualitative fundamental analysis to consider. There is a school of thought out there that says that management is the most important criterion for investing in a company. After all, even the best business model is doomed if those who are executing it screw it up. Now, as a layman investor, you're probably not going to put a company's management under the microscope, but you can typically look up the resumes of the top brass and the board members, and you can get an insight into how they're operating day to day. For example, are they unloading stock and looking to get off the ship before it sinks? Are they overpriced Ivy League graduates, underpaid and overworked, over the hill and unwilling to change, inexperienced and making all the wrong decisions? You typically find out things like that just by doing your research via a company's website, or gasp, even sending an email to the company's investor relations email address. Sometimes looking at things like LinkedIn and other social media sites can help you to get a gauge into the company's management makeup as well. All things to consider. And once you've gone over the management, you probably want to go over their governance. Reviewing a company's corporate governance to ensure that the relationship and responsibilities between their management, directors, and stakeholders is a key to ensuring that the company is on the up and up. You don't want to get stuck in the company that's doing a little shady business, if you know what I mean. You can typically find this info in the company's charter and its bylaws. In addition to that, you don't want to overlook the company's customer base, its market share, its industry-wide growth, its competition. Is it the only game in town, or just one of thousands of companies all doing the same thing? You want to consider the regulatory environment. Is the business they are in highly regulated, or does anything go? Is their management helping to position them to be more compliant, or to buck the system? depending on the macroeconomic position that they're in. Both positions could help to grow the company, believe it or not. Also consider the business cycle of their industries. Are they in an industry that's dying? For example, videotape rentals. Are they in an industry that's growing? For example, streaming services. Does the company only really make money during the holiday season, similar to retail outfits and online shops? Or is it a year-round powerhouse like streaming? And that's just a small sampling of the qualitative fundamentals that you can take a look at. We haven't even gotten into the quantitative fundamentals. Let's do that next. This is where it typically gets tough to stick with the research. But don't give up yet. If this side of the equation doesn't hold up, that company may not be long for this world, and your money right along with it. Start by looking at a company's balance sheet. The balance sheet represents a record of a company's assets, its liabilities, and its equity at a particular point in time. It's very similar to calculating your net worth, but of course, it's more specific to a company. We all know that famous equation, assets equals liabilities plus shareholder equity, or do we? Well, now you do. Assets, or the left side of the equation, represents the resources that the business owns or controls at a given point in time. You know, cash, inventory, machinery, real estate, all that good stuff. The right side of the equation represents the total value of the financing that the company has used to acquire those assets, acquired through liabilities, debt, bonds or things of that nature, to any number of institutions that must be paid back, and shareholder equity. The shareholder equity represents the total value of the money that the owners have contributed to the business. With that understanding under your belt, now you need to understand where the income for the company is coming from. Looking at the income statement of a company will tell you about the revenue that was generated as a result of the business's operations over that period of time. That period of time that we're talking about is typically a quarter if you're looking at publicly traded companies. And then you have cash flow statements. This is a record of a business's cash inflows and outflows over a period of time. Typically, you'll see things like cash from investing, which represents cash used for investing in an asset. You'll also see cash from financing, which is the cash that a business is getting for operations from the issuance of stocks or from borrowing funds. And then, of course, you have operating cash flow. This is considered the cash generated from day-to-day business operations. Cash flow statements are an important part of your fundamental research, since this is the hardest part to game with aggressive accounting manipulation. There can be quite a bit of fancy accounting footwork to help make your yearly earnings look nice, but not a lot you can do to make cash in the bank look nice. There's just so much more to fundamental analysis that this could easily be a 2-hour video. Show your appreciation for my willpower to keep this video short by liking this video and dropping a comment about how you analyze investment opportunities. Do you invest in individual stocks? If you do you go by the fundamental analysis school of thought, the technical analysis school of thought, the efficient market hypotheses, or some other methodology? Or do you not even know what any of this means? Trust me, we're all dying to know. So be sure to subscribe to this channel with post notifications turned on so you don't miss a great video just like this one when they're dropped. And of course, comment down below and like and subscribe. And don't forget to share with your other financially minded friends, or send this over to your financial advisor. See what they have to think. And keep in mind, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Thanks for watching this video, guys, and I'll catch you in the next one. Peace.